it should. Okay, recording has begun, and it is May 2nd, which means that people like Steve Hicks, who probably are devout Cinco de Mayo celebrators, will do that on Sunday. Cinco de Mayo is on Sunday. But anyway, it's May 2nd, 2024. This is the Edge live demo and discussion. I'm Tim Quast. Along with me is Henry Howard, our head of client support. And so we're going to tag team today and give you hopefully some good lessons on basic mechanics and some ways to think about the data. And so I'm going to introduce Henry for part one, and then I'll pick up part two. So over to you, Henry.
Great. Well, thanks. Yeah, like Tim said, I am a guitar player. I love having my guitar in the background. I like to write songs. I spent some time in Nashville, and actually that was part of the time I started. And then yes, I was patient zero with Tim. Still proud to be alive, actually. So I do this every week. Some of you who have been on these calls, this might be old hat. But my first and foremost, I am a very processed in my digestion of data. And so I'm going to walk everyone through my process of going through Edge each day, the elements that I look at, and then also some of the things that I mentioned in the desk note yesterday that I'm going to reflect on, and then I'll hand it back to Tim. So let me share my window here. All right, there we go. So obviously we have our dashboard here. I'm going to point out, I'll get back to this. This is I mentioned this is my mega cap portfolio, which is another sort of visual representation of what is happening in the market. So I'll get back to that. But the first and foremost, the thing that I start off with, there's really a handful of elements, but the first and foremost is broad market sentiment. So, last time we were on this call, I asked Brian Wilson, how do you weight broad sentiment versus short volume? And so I give the most weight to broad market sentiment. And what's happening within that. And then second, I'll give a secondary weight to what's happening in our short volume. So obviously, we had this really strong recovery from this bottom here, and we've been watching, days like yesterday where we know there's a Fed meeting, where we had come out of options expirations, and there's I'm weighting those contextual things pretty high, but also just realizing where we are relatively, that 50%, over 50% short volume is not necessarily with rising short volumes is not the place where I'm looking to get to risk on. So that's the first element. The second element that I'm really looking at is actually the number of components in both of our portfolios. So if you'll notice in momentum, there's now 15. I think yesterday that number was 6. And so we're seeing I think when we had we were talking about the breadth, everybody's talking about the breadth push, is what I'm looking for is going forward, how many of these companies are popping up in our more momentum portfolio, and then also how many are popping up in our low volatility portfolio. So that's the next, is like how many of those components are starting to find strength. And so seeing this morning, I said that's a really good sign to me that there's more companies coming into that portfolio. And I used to sort for this. I mentioned that Edge has a lot of different tools. I used to have to sort this and build portfolios myself. Now I just look at the number of companies in momentum and low volatility. And then my third element is I'll go to our big tech portfolio. I always talk about big tech. We talk about the amount of market cap that's in big tech. And what I'm seeing is, it's very similar in our broad sentiment, but these names that are 58%, 52%, even, I feel like 2 weeks ago, these names were all at 32 to 38% short volume. So we see that reflected in our broad market, but it gives me a really good sense of what direction these really big names are moving. So that's kind of my second look. I will take a peek at what's happening over here as far as fast trading. Is it active trading? Tim can mention, this the passive money is really driving so much. So when I see that, more of these names taking up a passive behavior, I know that's, there's a significant amount of money behind these names coming into the market. Okay, so that's the, sort of the third element. And then after I've done the sort of broader higher up, I'll go to our trading ideas. And I like to sort this. Brian does it high to low, low to high. I do it high to low. And the one thing I want to mention is I like to see what sector, where are there multiples in a sector, because I want to, not only do I want to have the broad market support, I want to have that sector support for all those people who say, oh, I only do I only trade this retail ETF, or I only do this tech ETF. I'll look at these sectors. Yesterday I mentioned low volatility and the names were in it, and just getting familiar with the names and how they're moving together, so that as a discretionary trader, I have all these tools when I go to make a trade, that I have these and all these different components in the back of my mind. And then obviously, the being able to weight these probabilities appropriately. Like, these are things we weren't able to do even a year ago. So this is really valuable. The only other thing I'll look at, and that I mentioned, is this volatility metric. Understanding for me how a stock moves. So I have a handful of stocks and sector ETFs that I'm really familiar with, of how they move. And even a day like yesterday, where we understand there's going to be increased volatility, to understand what those expected moves are, understanding, where those bands of volatility are, and really those bands of liquidity are. That's what I'm looking for. And a lot of it is just providing that context for when I go to make a trade and make a decision. So that's the daily process. I'll get back here. If there's any other questions, feel free to shoot them out. At the beginning, I said I want to take a peek at this mega cap. What I saw here yesterday was this, and I didn't mention it in the note, because those Fed days I'm okay with sitting out. But seeing that this short volume had actually begun to peak yesterday, that I wasn't concerned that we were going to fall apart, or that we were going to have another move down. I think the risk off, the context was the risk off came on Tuesday, where we had those, in the mini futures, at least in SPY, we just had these really measured moves where it was like 20 points, 20 points, 20 points, until at the end of the day, there wasn't enough time left in the day to liquefy positions before the Fed. So anyways, those are the things that I'm looking at. Tim, I'll hand it back to you, and you can make any corrections or adjustments that you'd like.
Oh, far be it from me to do that. No, that was excellent. Thank you, Henry. I like when Henry writes the notes, because he's very methodical. It's about doing certain things each day, and it's a great approach. It's I think that very much the correct approach. Gotcha, KP. Thank you very much for the clarification. I thought that was some technical measure that I did not know. So, okay, here's my plan. I want to talk about what high supply means. Let me. I have to reference my list. What to learn about month end? I mean, the month ends are pretty important, and it's what Henry talked about. What happened on April 30 and May 1, very much about month end true ups for passive money. That money relies heavily on S&P options and futures, because there's very little underlying liquidity. I don't know if you realize this, but the average trade size in the S&P 500 is 92 shares. It's not even the regulatory minimum bid and ask quote, which is 100 shares. The SEC tried to change that. They tried to break the market into tranches, so that if the price of the stock was I believe over $1,000, one share would be a round lot. Between 500 and 1,000, I think it was 10 shares. Between 100 and 500, like 20 shares, and then 100 shares. And that was part of these revisions to what's called Regulation National Market System. We commented on it. Many people commented on it. We were opposed to the changes. And ultimately, the changes were shot down. So there are a couple of things I want to describe out of that today that you can use with Edge. Good things to know. But anyway, so trade size is very small. There's not much liquidity because all the stock is owned. I mean, institutions own the stock. So how is it we can buy and sell stuff? Well, it's because of short volume supply and the regulations that govern that. And I'll talk about that a little bit. So just so you know, and I'll combine KP your question and JC your question to do that. Let me go to my dashboard. And by the way, if you're not using Edge, if you're just accessing the daily trading ideas through Interactive Brokers, which you can, I do that. I can look at it on my phone. It's a little more difficult, but on my desktop, I'll pull our daily trading ideas up because I can go right to the buy sell button and I just look at my entry points, right? That's what I'm going to do, and did it today. I'll tell you about that. But here's the point. If you go over here and you look at, let's say you want to look at GEV, in those daily trading ideas, there's broad sentiment. Broad market is broad market sentiment. It's just shortened to make it easy to absorb. And you can see that the broad market sentiment as well. Here, let me move this down. Okay. So you can see the same thing, which leads us into this, what I want to describe about the supply side. Supply is the data set associated with what's called Reg SHO Rule 201. That's the modified uptick rule. There's a rule governing how one can short stocks. It used to be, prior to 2007, as some of you veterans probably know, you could only short a stock on an uptick. And the SEC thought that was antiquated, did away with it. We had the financial crisis, people complained, and they implemented this rule called Rule 201. And so now stocks have girders. If a stock moves a certain amount in a certain period of time, then it will be paused. And then if it happens again, then it gets halted. And there are three things. But the data set out of that is governed by FINRA. And FINRA requires brokers who execute trades to report, last I saw, 86 different things. The executing broker reports it electronically within 10 seconds. A lot faster than that, but that's the regulatory requirement. And one of those things is, are the shares involved in this trade owned by you or your customer, or are they borrowed? And if you're a market maker engaged in bona fide market making, meaning you're at the bid or the offer, bid and offer, you're making bids and offers, you're exempt from Reg SHO Rule 203b2, which requires that you locate shares to short. They don't have to do that. And why would the SEC permit that? The SEC doesn't just permit it, they require it. And it's because they want to make sure there are 100 shares at the bid and the offer. That's one of the reasons they wanted to change it to, stock trades for $500. Let's just have 10 shares at the bid and the offer, so there's less short volume, less supply, because market makers create that. Well, the beautiful thing for us is we can see directional change. And I just want to point this out, that we talked about how the supply side, so that's what that is. It's 50% of all volume routinely doesn't really exist. It is there to make sure that transactions occur. And the demand side, to answer your question, KP, about this, it is not a measure of a combination of moving averages. I am not a big fan of moving averages because you don't know what is setting them. There are different purposes and time horizons in the market. Half the volume in the market has a purpose and time horizon of a day or less. Well, if your averages are built on significantly longer periods of time, and that behavior jumps from 45 to 75% of the volume, the market's going to deteriorate and your moving averages are not going to help you know. And so we have found them not to be good signals of what the market's going to do because they're consequences of things that have occurred. We would much rather know what is occurring now and what it's likely to produce. And what we know is falling demand and rising supply most times brings prices down. It doesn't always. If you backed up to January options expirations, you would look at it and say, well, demand was falling and supply was rising, and yet the market just went flat. It didn't fall. And then everybody piled into options at the January expirations date, and off to the races we went, and supply declined and demand rose. So it's not always true, but it's generally true. You know, you can see here, insufficient supply, generally demand that was fine. And what did the market do? It rose. It stopped rising when supply peaked, right as the new series of options traded in March. This was the market big short. That was the end of the trade, the long trade. And we saw it all over the market. I've talked about it before. So is demand superior to supply? Generally, yes. But if demand is plateaued and supply rises, then all of a sudden supply takes the lead. And it's very important for you to know. I've got PBR up here, and I'll show you this. You know, so I will sell PBR today because I don't know what's going to happen with jobs data tomorrow. Hasn't given me the return I had hoped it would give. And see the supply side? Demand is fine. Demand is as strong as it can get. But when the supply side rises, it's not huge, but it's a move from 39 to 4. That's more than a 10% move. So why don't I go find something else? Okay, it doesn't always produce return. I've got a positive trade in this. I just didn't make the 2% that I'd hoped. It's less than that right now. And there's still time left in the day. So that's when supply takes precedence. And so I will reiterate that watching the supply trend is pretty important in the broad market. I'm going to back up 3 years, and I'll finish with this point. You can go back and look and see when monetary policy or expectations changed. Here was very low supply. And what happened in February? Well, actually, it was in March. What happened in March of 2022? The Fed started hiking rates. So it was already baked into models before that happened. Supply shot up dramatically, and that's where the market ceased performing well. Then you get to where the Fed reset the expectations and said, okay, we're not going to hike anymore. And we'll look what happened on the supply side. Supply dipped just like it did here. The market becomes ever more dependent on supply, so the long-term trend continues to rise. Now where are we? Well, you could tell it's uncertain. It's not great. Basically, money is exactly long and short. It is market neutral. And I don't know what will happen. We'll see how it goes. But that's why supply is pretty important. Henry is right. Demand first, supply second, but watch the supply trend. And there's another important principle to me, and it is not a 100% probability. It is a reasonable central tendency, and it is that we say weak tops precede drops. It's a catchy, quaint little phrase, and you might say, well, is it really true? Here's what I mean. I'm going to expand this all the way out to the maximum data set. And what we have found historically is that so the red line is a statistical top. The green line's a statistical bottom. Notice this was a huge bottom for the market, and this was a huge bottom for the market. This is where if the demand drops all the way down to 2, there is a very, very high statistical probability. You might not get it just right, but that is a market bottom. And you could put more money into your long-term portfolios and because you're going to have a very high probability in the months ahead that the market's going to rise. That's not for short-term trading. That's much longer term. But note this phenomenon. See this? Here's the demand side. This is momentum, and then it begins to decline. And when the market stops rising over the red line, markets have a propensity to fall. It was even happening ahead of the pandemic. We had this very strong momentum market, and it's wearing out, weak tops, proceed drops. Then we put all this money to work in the market. The government plowed money into people's accounts, and they became day traders, and we had massive momentum that deteriorated. We told public companies that the momentum market ended in May 2021. Now there's a carryover. When you have that much momentum, it's like a rocket. You can burn the fuel all up, and it still carries for a while before it begins to decline. But there's no question that a weak top preceded a drop. So it's just good to know. It happened here too. Momentum's declining, weak top, boom, market tipped over. Well, where are we? Well, I don't love it. Right? If you look at this, we had a very furious momentum market short term based purely on monetary policy. And it's already run out of steam, and we have a weak top. Now, I'm not saying it's preceding a drop, but the market did drop. And I don't know if it's over. I think the key will be the supply side. If I look at the supply side, it's kind of interesting. This was a great momentum period. That's the pandemic bull market. We had a very short one here on monetary policy. Now the supply is here. It's just, I'm helping you understand how to look at this data and understand how the market functions now. Another thing that I like to think about in the same vein, it's not a predictive instrument because it depends on arbitrage, but SPY. To look at the supply trend in SPY, let's just back it up a year and look at that, and I'll move on to the next thing. SPY is going to spend a lot of time at 5 because it is the market. Most of the money, more than 50% of all assets, are passive large cap blend. That means they're large cap stocks, the BlackRock, Vanguard, State Street, Geode, and so on. Effectively the 25 largest holders in the market now today are either passives or closet indexers, meaning they say they're active, but they're following models. They're going to follow the averages. And so the SPY is going to be at 5 most of the time. We had this breakdown. We had this little breakdown, but it's almost always, there's almost always another shoe. So if we'd have one shoe, there's probably going to be another. And if you look at the supply side, it's back over trend. It did tick down. Yesterday was a big covering day in SPY. If you look at a month, and you can really see this sharp drop below trend. That supports what Henry said. You look at the momentum portfolio, short-term opportunity for momentum. Look at the market. We've had, I don't know how long it's going to last, but all of these data tell us we have a short-term opportunity for some returns. And so that's just very useful to understand the long-term trends and how beautifully you can see supply and demand in the market. And demand for us is not moving averages. It is a combination of the 4 big reasons people buy and sell stocks: story, characteristics, price, and an associated derivative. And we model those data in trade executions and weight them in a model and compare them to midpoint price and how those things are evolving in 5-day moving periods. And why? Because most orders take 5 days to work through the market. How do we know that? We've tracked the patterns. And so it's not built on moving averages. It's built on supply and demand in the form of executed trades by different purposes and time horizons. It's wholly mathematical and behavioral and not dependent on price. It's dependent on the contribution of those components. Okay, now I want to finish with, did I cover everything I wanted to cover on that one? Okay, month ends. I want to talk briefly about month ends because I think they're important to know. Month ends, so typically the expirations occur right in a row. Sometimes they're split into 2 separate weeks, but this one, there's March 28th. 29th was Good Friday. Back here, the February 29th, big move. Here, big move. Here, big move. They're not always, but what is occurring there is that trillions of dollars are getting squared to the benchmark. Let's say it's the S&P 500 because the great bulk of them are. 88% of market cap is in the S&P 500. So then if you have a true up here, new options trading here that people have in their models, and the market declines, what is likely to happen? It's not an absolute, but it's probable that people don't need as many. Well, what may the market do? Well, it might tip over, and we might get a clue from the supply side, because the people who sold them are going to hedge themselves ahead of the next series. And you could kind of see that in the data. They're not perfect. We don't talk about all the details we can see. We try to stay focused on the central tendencies. Watch broad sentiment, right? Understand the context. Are there options expiring? Is Jay Powell speaking? Those kind of things. And then we trade divergence. But they're very interesting things to know. And you could back up. I'll do it just 1 year here and look at the month ends. It's not the only reason. There are other things that occur. But all through here, month ends are pretty important. And so you need to think about those as a trader. It was a very difficult period to trade, wasn't it? Using the momentum and low volatility portfolios was harder. I got stopped out of SE, got stopped out of MRK. Now I knew I was taking more risk. If I don't want to do that, then just avoid it. If you don't want to do it, just avoid those periods where you know there's likely to be a diminution of the reliability of probabilities because of things that are occurring, like Jay Powell speaking and month end. If you don't mind additional risk, then fine, but realize that it may not work. I mean, yesterday, I'm not advising that you do it, and it didn't work for me either. But I looked at the data and I said, okay, well, demand's rising, supply is too, but I would expect that there's a long bias in the data. So if the market is, ahead of the Fed's press conference, I'm going to put on a long and a short levered ETF, and I'm going to bias it to the long side, which was correct, except that I was having lunch with a friend of mine, and I missed all the gains. And then when I looked, it was down, and I had this, so by that time I got rid of the short hedge, and I lost money on that, but I was more than compensated for it on the long side. And then the long side went back down, and I had to get rid of it. And I made no money, right? So waste of time. So, so just know that that's the case. Okay, last thing is mechanics, and I'll take you through things that I think about. So with Petrobras, as I said, the supply side is beginning to rise, so I'm just going to leave whatever happens. But let's take a look at some examples. I bought, and I'm already out of it. I bought CPNG today. I mean, it's just by the way, you always want to check the earnings date. You can do it very easily at Google. They will actually tell you right there where it's scheduled. Very handy, right? You don't, you can do, if you're trading 20 stocks, this is kind of clunky. It doesn't really work. You could look at a full earnings calendar, look up by ticker, and I just want to look at the stock here, and I will compare it right to, so I exited at 22.61. So I put in a limit order right at the entry point offered by our daily trading ideas. So if you go up here and look at them, so let me sort those. Here's CPNG. So there's 2187. I thought, well, I could put it in between, but I thought I'm just going to put the limit order in at 2187, and it filled 4 minutes into the open, and it worked perfectly. And why did it work better now than it would have a couple of days ago? Because those distorting events are out of the way. Much higher probability. Would work with just about any of these. You could take, I put a limit order in for AEM at, I was outside of this. I should have, I didn't, I was hoping that it would come to me, and I should have just put it in at 63.27 because I think it would have filled today. And it's very high probability, and its examples just demonstrate it over and over that you can produce good returns. Yeah, so well, maybe you'd have to be just inside that 60, maybe closer to 64. But look, you could have made your money over and over and over. It's true, and you say, well, how is it that works? It's supply and demand. It's math. It's understanding how prices are set in the market, and that momentum stocks have a propensity to move about 3%. And all we want is a portion of that. Just take the portion and be happy with it. And it's just so much less stressful. It gets closer, Steve Hicks, to what you said, where where you want to arrive is set and forget, where you have and the best way to do that is to put your, if you've got an entry range, be just a little bit inside that range. So you have a higher probability of a fill. And then you can put in a limit order. So mine was sitting between these about 2261, and then you just walk away as long as there's nothing else occurring. It's just a very easy way to approach it. Why not? And same really with low volatility. I've got one other thing I want to share with you here. I think Steve does this. If you set your stop roughly 1% down, I don't want to lose more than that, and it happens on occasion. And your limit 1% up, and you're within the bracket. The probability when these conditions exist that you can produce a return is very high. Statistically, 100%. Doesn't mean it's going to happen. Past performance is no guarantee of future outcomes. But this is what we're trying to do. We're using math and the mechanics of the market to achieve the highest possibility of a reasonable, repeating, good return. Last thing I'll share with you. So sometimes I sort by volatility. If I want a little bit more, then I may say, and I own GEV, and it's not doing as well as I'd hoped, but pre-market it was. I thought, man, it's perfect. But it was 159. So I had made a great sum before the market opened, and now it's sitting around this, the high entry point, I think. But that's one thing you can do. Here's another thing to know. The spread sometimes can be an issue. The truth of the market is that the SEC likes stocks to be priced between $20 and $50. When they ran tick studies and looked at tick sizes, what's the movement of a stock, they found that the market works the best between $20 and $50. That's where if they had their way, all stocks would have the same price. Why? Because then the market would work in the model perfectly. Right? We tell public companies, you're better off having a higher price because you will have less proportionate arbitrage. If the spread between the bid and the offer is 10 or 15 cents, there is a much lower probability that a machine is going to cross that spread and fill your order. It's less, you say that's less liquid. Yeah, but the time frame is probably better. So if I'm trading short term, sometimes I like these stocks between 20 and 50 because I know it's going to have a penny spread, and the probability of producing my 2% return in short order in a day is very high because they are perfectly comported with what the SEC has created in the mechanics and rules of the market. The market is very, very, very heavily regulated. Everything in it is regulated, and that makes it mathematical, and we're just taking advantage of that. Okay, the last thing before we finish is a very quick look at what's ahead. I'll just go back to this and say we've had a weak top. I think we're going to stop at about 6 again. The supply side, not great. We have a short-term window here because we know in daily trading ideas, as Henry pointed out, we got 15 and 15. They're narrowed a little bit in daily trading ideas because some of those don't have 50% probabilities. So short window, keep your horizons relatively short, 1 to 5 days, we say, and we'll keep a very close eye on this relationship between broad sentiment and supply. I don't think it's an awesome market, but we have a little bit of time to trade. Okay. Questions, comments, thoughts, and observations? JC, please go ahead.
I just have one question following up on the forward look.
Oh, it's you, John. I thought it was you, but I wasn't sure.
No camera today. So yeah, it looked similar. Just looking at the data, have you guys looked at? Well, a couple of things. First of all, when we make bottoms, it seems like we touch below 3 or around 3 a couple times before the market tends to turn around. Have you studied have you guys run the data on that? And then 2, similar, in conjunction with that, looking at short volume, it seems like it's the steep the steep rate of change in short volume that makes a difference, right? Because I'm tracking that every day, and short volume while moving up is moving up very small. It almost looks like it's like kind of triple top, like it's having a weak top, and now it feels like it's rolling over. So yeah, I mean, the market is at odds, right? It feels like people are short, but people are buying a little bit too. So I was just curious if you guys studied that stuff at all and see that in the data.
We have not statistically looked at whether, if it drops below 3, does that happen again? But looking anecdotally, it has certainly been true. Yes. And I agree with you. It's interesting. The rate of change also is highly correlated to fails to deliver. So a fail to deliver is when somebody buys a stock and it doesn't settle because there's no stock. And it happens even in SPY on occasion. I know a major firm, I had a discussion with the head of trading. He said, I had $1 billion fail to deliver in SPY. And I had to go to the CFO and say, I need a check for about 3 days. And that's not what you want. But the same thing is true, John. That steep rise on the supply side is highly, we looked at in particular 3 instances where there were big fails to deliver, and all of them had it. All of them had a sharp rise in volume and corresponding rise in price, and then a sudden drop associated with a sharp rise in supply. And so we're looking at that as a potential fails to deliver signal. But I think you're right, and that's what happened in March, and it's not quite the same right now. No. Okay, what else?
Your weekly update.
Good. I want to hear it. Yes. It probably wasn't as good this time. This was a tougher period.
Oh no, it was good.
Excellent.
Yeah, I'm now at 16% for 29 days.
I think we should just give all our money to you, Steve, and let you do it.
No way. It's all automated.
The Hicks hedge fund is formed.
It's just strictly using the data that you're providing on the daily trade ideas. And it's with a 2% up for momentum and 2% down for a stop, and 1% up and 1% down on the low volatility. But it cranked very well during the last week. So
I'm very glad to hear it. I'm following that example too, Steve. And I'm, it was a lovely day today. I produced better than a 2% return. Yeah. And it just did that. Yeah. So thank you for the continued feedback. As I said, we've got a bunch of projects. So Nate's got this in the queue to give us some real data visuals on performance based on both portfolios. And we'll do a year. Well, I'd like him to do 3 years, but we'll get there. We're in the middle of a major Azure move because Microsoft, just forces you to upgrade stuff. So I've got 2 of our 3 engineers on that right now. Thank you. Thank you for the feedback. Anything else? Ann, you can sign for 30. Yes, you can. Ann says, if you're an IBKR user, you can sign up for a 30-day free trial. You can anyway. Yeah, we have a 30-day trial. So yeah, I mean, it's easy you don't have, you can make use of it and give it a try. Let's see, did I miss anything?
Tim,
Yeah.
I'll ask a question.
Yeah.
We're in the midst of earnings, and can you talk about the relationship between short volume and earnings, and why sometimes it's difficult to trust the data during earnings?
I sure can. That's a great question. So most of the time, a strong supply-demand divergence like this will be correct. But it isn't always, because earnings, while I wish that it were about fundamentals and how a stock performs relative to consensus, realize that consensus is there are 8 broker-dealers that generate enough consistent customer order flow to support research. There are 320 or so firms, if you count everybody, who that write research, but very few of them really matter. So really what happens behind the scenes, and the reason this is not reliable, is because there are all kinds of bets that are made. Hedge funds are going to consume every conceivable form of alt data not credit card, much more sophisticated, supply chain data, parking lot satellite images, everything. And they're going to make levered bets on numbers, and machines read press releases and they consume them and they compare them to data in a data warehouse, and that's fed through an execution management system that is automated and incredibly fast and powerful. And if there's any data point that doesn't match, that ties to how their systems are set to directionally move, they can tip a stock over. So you just can't rely on it. I mean, you can look at Carvana. Carvana, stock shouldn't be up 30% in a day. Well, how did that happen? On that, you'd look at that and say, John Cook would say, well, that's evidence that a lot of people bought it. Could be true. Could be true. You'd look at that, though, and say there's just as high a chance that this stock tips over than that very strong demand ramp drives the price up. It's risky. So you have to be aware that it's very risky. Lastly, consolidate. Yes, the cat. Well, okay. So Rob, what I would say about, yes, I mean, the consolidated audit trail has been a long-term thing, and there are all kinds of massive amounts of money spent on it. And they have great data. They do. So does FINRA. I mean, the reason they can know almost everything about trading is they are monitoring all of those things. Realize that Citadel is doing what the SEC has asked. Citadel is it is the largest buyer of retail order flow. It is the largest single market maker. It is the dominant DMM, designated market maker at the NYSE. They have over 1,200 of all. They have most of the listings. And so the SEC gives them wide leeway to make markets because they believe Citadel will keep the market functioning and fill bids and fill trades by being at the bid and the ask consistently. So are they evil? They're not evil. They're just they're treated that way because they're such a central part of the market. And I'm not concerned about them. I don't love all this short volume. I don't think we have a market that is very efficient for capital formation. I do think we have a great market for trading because of all this stuff. We just have to be happy taking what Citadel gives. And Citadel will give us 1 to 5 days, and they'll give us 1 to 2%. Okay, we'll take those. I don't disagree, John. That's crazy to me. It's Carvana. It's just really something. Okay.
I mean, valuation matters at some point, right? Like
you hope it does, but realize that 70% of the money in the market now doesn't make decisions on the basis of valuation. It makes decisions based on its need for a certain amount of equity. And that's part of the problem in the market. When the market is passive, it's not passive. Realize this. Do you know that 1/3 of all trades occur in the last 10 minutes? 1/3 of all the average S&P 500 stock trades 55,000 times a day. And 1/3 of those are occurring now in the last 10 minutes. Why? Because passive money constantly tries to get rid of volatility. They want to be the 1%. They just want to be right there, and they need the price at the close. That's the reference price. So all that order gets jammed into the finish. Well, and so we know those things, right? That's what's showing up in supply and demand. We know which direction those orders are going. And when demand falls and supply rises, we know they're selling. And if demand rises and supply falls, they're buying. So that's what we're doing. Okay, we went a little long, but I hope it's helpful. We try to help you understand how the market works, and then be like Steve. That's what you want to be. Okay, you guys, we'll see you next week. Thank you very much.